Loan prime rates, an overview. Understanding the basics of lending industry. Presentation overview. Defining loan prime rates. Loan prime rates are a type of interest rates that are used by banks to determine the interest rates for loans. We'll compare loan prime rates with other rates to better understand their significance. Factors affecting loan prime rates. We'll explore how banks use loan prime rates and the factors that affect them, including inflation, economic growth, and monetary policies. Impact on the economy. Loan prime rates have a significant impact on the economy as they affect the borrowing and lending practices of banks and individuals. We'll examine the impact of loan prime rates on the economy and look at some practical examples. What are loan prime rates? Loan prime rates are interest rates that commercial banks charge their best clients. They're determined by the central bank and are based on the cost of funds, inflation, market demand, and other factors. Benchmark lending rate. The benchmark lending rate is the interest rate that a central bank or other monetary authority sets and uses as a benchmark to set other rates. It is used to influence economic growth and inflation. Factors affecting loan prime rates. Loan prime rates are affected by a basket of factors such as the cost of funds, inflation, market demand, and other economic indicators. Definition of loan prime rates. Loan prime rates are the interest rates that commercial banks charge their best clients, which are determined by the central bank and based on factors as the cost of funds, inflation, and market demand. Comparison with other rates. Loan prime rates. Loan prime rates are exclusively available to the best clients of commercial banks and are generally lower than other interest rates. Benchmark lending rate. Benchmark lending rate is a general interest rate that applies to all clients of commercial banks, regardless of their creditworthiness or risk profile. How are loan prime rates used? Definition of loan prime rate. Loan prime rates are the interest rates that banks charge their best clients for loans. These clients are typically large corporations with a good credit rating and a long-standing relationship with the bank. Factors that affect loan prime rates. Loan prime rates are affected by many factors, including the creditworthiness of the borrower, the current economic conditions, and the bank's own cost of funds. How banks use loan prime rates. Loan prime rates are used by banks to determine the interest rates they charge their best clients for loans. These clients are typically large corporations with a good credit rating. Determining interest rates. Banks use loan prime rates to determine the interest rates they charge their best clients for loans. These clients are typically large corporations with a good credit rating. Benchmark for other loans. Banks may also use loan prime rates as a benchmark for other loans, helping them to determine appropriate interest rates for a variety of clients and situations. Factors affecting the loan prime rates. Cost of funds. The loan prime rate is affected by the cost of funds, which is the interest rate the bank pays for the money they lend. If the cost of funds increases, the loan prime rates may also increase. Inflation. Inflation affects the loan prime rates because it reduces the purchasing power of money. If inflation increases, the loan prime rates may also increase to compensate for the decrease in the value of money. Market demand. The loan prime rate is also affected by market demand for loans. If there is high demand for loans, the loan prime rate may increase to balance the supply and demand of funds. The impact of loan prime rates. What are loan prime rates? Loan prime rates are interest rates that banks charge their most credit-worthy clients, usually large corporations. These rates have a direct impact on the cost of borrowing and can influence investment decisions. Effect on the economy. Loan prime rates have a significant impact on the economy as they affect the cost of borrowing for large corporations and can influence investment decisions. Changes in loan prime rates can cause fluctuations in the stock market and affect economic growth. Practical examples. Loan prime rates can have practical examples in the real world. For example, a lower loan prime rate may encourage companies to borrow more money to make investments in their businesses, while a higher loan prime rate may discourage borrowing and lead to a slowdown in economic activity. How loan prime rates affect the economy. Cost of borrowing. Loan prime rates have a direct impact on the cost of borrowing for large corporations. When interest rates are high, borrowing becomes more expensive and companies may limit their investment plans. Signal of monetary policy. Central banks use loan prime rates to signal their stance on monetary policy. When interest rates are high, it signals that the central bank is trying to cool down an overheating economy. When interest rates are low, it signals that the central bank is trying to stimulate economic growth. In conclusion, loan prime rates are a critical aspect of lending and have a significant impact on the economy. Understanding how loan prime rates work and their impact on borrowers, lenders, and the economy can help us make better financial decisions. Thank you.